So in the last 30 years, from 30 million to 1.7 billion, that's a pretty big jump.
Well, yeah.
All right, David Anderson, episode 9 of the Deal Ranch. Thank you so much for doing this. It's a huge, huge honor. I'm very excited about this episode.
Good, glad to be here.
So we can start with your intro on yourself, but we're sitting here at Anderson Brothers Bank. This is your family's bank, and you guys have been in business this is the 90th year.
Right.
You're the president and CEO. So today I just really want to talk about the history of the bank and then how you evolved into the CEO role. If we want to talk about different market cycles, what you guys were doing then, but that would be neat as well. And then lastly, you guys keep growing and you're one of the strongest banks in the state. So it would be awesome just to hear a little bit more about the story.
Right. Just by way of introduction,
Yeah.
I've been with the bank 44 years this December.
Wow.
Yeah. Not only that, I've been working in the same building for 44 years, which is unusual, I would think, in this day and time.
Yeah.
I've been CEO for 30 years this past April. And currently, as far as the bank's concerned, we're a 1.7 billion. Got about 25 branches, a little over 400 employees, which is a lot of employees for a bank our size. But we are deep in the consumer lending business, so that requires a lot of employees. So that's more than what you would typically see.
Absolutely. And if you want to kick it off kind of with the history of the bank, it's an immaculate story. So starting in 1933, your grandfather and his brother were in the tobacco business.
Right.
So during the Great Depression, it seemed like the tobacco business in Mullins, where the bank started, was going to dry up. So then insert your family story.
There was two banks in Mullins that both failed in 1931. And then there was no bank in town, and we had a very robust tobacco market at that time. And both my granddaddy and his brother were in the warehouse business. When I say warehouse, that's not storage. They provide a warehouse and a facility for farmers to bring their crop in, and then they hire an auctioneer, and then they have the cigarette makers come in and bid on the tobacco.
Wow.
And both of them were in that business separately, but that was their main business at the time. And then when the banks went under and there was no business, no bank in town, they decided to open a bank, and they were encouraged to do that because the merchants were concerned, because they thought people would go to Marion, which is 9 miles away, and do their banking there, and then they'd spend their money there. So they needed a bank. And so they started the bank in the back of, I'm pretty sure it was what was called Anderson Warehouse at the time, which was owned by my great uncle. And so they were in it 50-50 at the time, and that 50-50 partnership worked out well for 60 years. And in 1993, we acquired our cousin's interest.
Wow.
And then at that time, we were about a $55 million bank, a branch in Ainer and a branch in North Myrtle Beach. And so in 2000, we merged Anderson Brothers Bank with Anderson State Bank. Anderson State Bank was another bank in Hemingway, Johnsonville, and Kingstree that we had controlling interest in. So we merged those two together. And at that time, we were about a $160 million bank. And I got a shout out to my brother. It was his idea to put the two banks together.
Oh, really?
My oldest brother, Neil, after a board meeting in 1998, said, "Why don't we put these two banks together and you be president? It seems to be more your interest than it is mine." Yeah. And so we did, and it's worked out very well. So shout out to him. And then the next thing we know, we got very lucky. The next thing that happened during this time, we're building branches,
right,
as you can see on our timeline.
That's right.
But in 2005, we were very fortunate to have a really tough examination. Now, banks are highly regulated. Every 12 to 18 months, you have the FDIC or the state coming in with a team of examiners, and they're going to look at everything you're doing, and they're good at it, and no stone is unturned.
Right.
So we had a really tough exam. We had a group come in from Boston, which is very unusual. Why they sent a team from Boston in to examine us, I don't know, but they did. And they wrote a scathing report to us about our risk management practices. And when that report got to Atlanta, I got a call saying, "Hey, what are y'all doing down there? You got to do better."
So who'd you get the call? Who does that call come from?
It come from the FDIC in Atlanta, yeah. So anyway, I knew we had to do better. And at the time, we were doing very well financially. And that's part of the problem. We're doing very well financially, but we had almost no middle management. It was basically me, a cashier, and then some branch managers. We didn't have any really bureaucracy to administrative state to rely on.
Right.
So anyway, we started that process. We hired a group out of a group called Sheshnoff, which at that time was the premier community bank consultants to come in and do a rather lengthy engagement. And from then we started adding staff and building that middle management layer, our senior management layer. And I was really fortunate. We got two people, our Rusty Richards and our chief operating officer, now our chief operating officer. Right. At the time, he was a branch manager. He came over to be our chief credit officer. And then we hired Dean Gorway, who was our chief financial officer now. She was a CSR and came over.
Oh, interesting.
In 2006 and 7. And they got there just in time to help us get through what was coming in 2008.
Right, exactly right.
We were really lucky to have those two on board to face what we were going to face in 2008.
Wow.
Yep.
How much did the shakeup from the FDIC and adding all the new people, besides 2008 kind of looming, how did that shake up operations for you as a bank? Like, did that change how you were able to operate the bank? Because your role...
As I say, we built the management structure there. We had very little management structure at all. Very little processes. Didn't have any credit analysts. Yeah. All those things. We added credit analysts with the department of 6 or 8 now. We hired, we hired so many people during that time. As I said, the credit analyst. And then also what happened when we came out of that process in 2012, we returned to profitability and the bank was going to be fine at that point. We hired Brian Leonards. Yep. Yeah, I'll tell you the story on that one.
Yeah, it'd be great to hear.
Yep.
And who's Brian now for an intro for anyone listening? What is Brian's role today?
Brian is he's an area executive for the Grand Strand and Florence.
Mm-hmm.
So we had lost our Conway branch manager there. And so I was looking for a branch manager for Conway, and I ran into a guy, Jim Graham, who used to be in banking and has some understanding of Conway market. And I said, well, who's the best banker in Conway? And he said, Brian Leonards, but you'll never get him. I said, well, why not? He said, because he's CEO material and he's not going to come to work for a little family-owned redneck bank like yours. So,
that's a compliment.
Yeah. So, of course, I called Brian. And we talked, and he was at that time with Walkamaw, who was limping along, so to speak. So anyway.
What year was this?
This was 2012.
Okay.
Yeah. And so anyway, we did a little kabuki dance there for a while, and he came to Mullins and met with us, and we had all those conversations that you have when you're trying to hire someone. Mm-hmm. And finally, he had strung us out for as long as he could, and he said, listen, I'm not really, don't have an interest. I'm a beach guy. My contacts are at the beach. I don't really know that many people in Conway. It's not really what I want. So I said, well, what do you want? And he said, and he launched into what his plan was. He had a plan for the Grand Strand from Little River to, I guess, Murrells Inlet. Mm-hmm. And so I said, wow. So anyway, we hung up the phone, and I looked at my chief operating officer who was there with me. I said, did you hear that? And he said, yeah, he ain't coming. I said, no, that's not what I heard. I heard he just mapped out a position that we had never done before. And so after a little bit of thinking on that, I contacted Brian, and we told him we'll create the position that you're looking for. We don't have one. We never had a regional officer. And so we made it up for him. So we'd be our Horry County executive.
Wow.
And anyway, we tricked him into coming. And so that was important for two things, because Brian has been so important. But also it was a change in our management. Before we were trying to manage and lead, I guess it was 8 branches in Horry County from Mullins. Right. And that's like herding cats. Mm-hmm. It's not going to happen. Yeah. You need leadership in and of that market, and so Brian was our guy to do that. So he came on board, and the first thing he started doing was interviewing bankers. He didn't go after customers immediately. He went after other bankers. So we interviewed 3 bankers, and finally got all 3 of them. It took 12 years to get one of them, but we did. We got them all. And also he had recruited Richard Carroll in our Conway office. And those two, and along with Rivers, have been just absolutely instrumental, and they brought us to the table in Horry County without question.
Wow. Prior to having Brian in the county in this position, what Horry County branches did you have leading up to that? Because when did North Myrtle Beach open, and then when did this branch
We
open?
opened North
here?
Myrtle Beach in '89. We got Longs. We got two
Conway.
offices in Conway. Excuse me, two offices in Loris.
Right.
Two offices in Conway. Ainer. We didn't have anything at Myrtle Beach at the time.
Got it.
Yeah.
Interesting. So when did this one open here?
This is Grissom you're talking about.
Oh,
This
2019,
was,
I see here.
3 years ago. We were
Yeah.
Market Common was our first office at the beach.
2017.
And then Grissom, actually we had a loan production office here before we had a branch. And Grissom, I guess 4 or 5 years ago.
Wow. I think that's an amazing intro and a great start. So speaking of timeline here, I had a couple questions just about the history. So it started in 1933, second branch opens in 1949. So what were after kind of just your grandfather and his uncle were lending money just to keep the tobacco market afloat, essentially. When did the services start to expand into deposit accounts and then checking? Like, how did that happen over the years? And then when did they start choosing different locations to expand to? So 1949, they opened in Hemingway, 62 in Ainer, then another branch in 66. How were they acquiring new locations, buying the banks, or
No.
how did things start to grow over time?
They started the bank in 33, and
Yep.
in 1962, they were approached by the town of Ainer to put a branch there. And my understanding is us and Conway National were invited to go to Ainer.
Oh, wow.
And we went first. And I think the reason is because they were mainly in the tobacco business, and there was a lot of farmers there. So it was synergistic to what their main business was, which
Yeah.
was tobacco warehouse. And then, what was the rest of the question was?
So as branches, you guys start to add them over time. How did they determine what markets you wanted to go into and like where to put a new branch? Because they look
Well,
not
they had,
necessarily-
but it was interesting because they started new banks. They started the bank in Hemingway.
Yeah.
All right, that's the Anderson State Bank.
Mm-hmm.
And I wondered, and they also had a bank in Loris and North Myrtle Beach, which was Farmers and Merchants Bank, which sold to National Bank of Sumter, which became NBSC, which is now Synovus.
Oh,
Then they had a
interesting.
bank in Dillon, which is Anderson Bank of Dillon, and it was sold to the Holden family, and it became the First Citizens of South Carolina.
Yeah.
So, yeah, I wonder why did they do different banks and not do branches? And I realized that because branches at that time, everything was done either manually or mechanically. So you had to have a new bookkeeping department for every branch, basically. So I remember our Ainer branch
fascinating.
back in the day, it was a bank on its own, really, except they would send information to update the books, keep a consolidated set of books. But it had its own bookkeeping department. It rendered its own statements, the whole thing, just as we did in Mullins. So there was really no reason to do a branch, just do another bank, and that's what they did.
Interesting. When you come in 1979, how much different was that than when you became CEO in 1993? So technology is slowly advancing. I heard on, I think maybe Jeremy Finger's podcast he did with you. I think you made a joke, something along the lines of there weren't calculators when you first started at the bank or something like that.
No, there was all mechanical calculators. There weren't
Yeah.
electric calculators. There was something called counter checks. We didn't have personalized checks.
Yeah.
There was no account number on them. You just, I just called a counter because merchants kept them on their counters.
Oh, wow.
Yeah, they just and you sign your name to it, and then we identified the accounts by the signature. Banking in '79 was highly regulated. Started deregulating in 1980, but when I got there in 1979, for example, you could get a passbook savings account paying 5%,
Yep.
a golden passbook paying 5.25%, a CD for 30 months paying 7%, or a CD for 60 months paying 7.5%.
Oh my God.
That was it. You couldn't do anything else. Then they started deregulating it slowly,
Yeah.
and they first started with something called NOW accounts, which stands for negotiable order of withdrawal, but it's just an interest-bearing checking account,
Okay.
is what it was. And they started out, and they were paying 5%, I think. And then they started deregulating CDs. They introduced what they call money market certificates of deposit, which
Got
was
it.
6-month CDs, and the rate was pinned to the treasury rates. And then they slowly deregulated that, took all the limits off the interest off it. So we're free to set our interest rates now according to the market rather than any index.
Wow.
So that happened in the very early 80s. So it changed pretty quick after I got there.
And had you worked at the bank growing up? Because you finished school in 79.
I did.
Oh, you did. Were you always planning on going back to work for the family bank or family business? Or
I started with the bank part-time in summers and during Christmas holidays in 1976, right after I graduated high school. And worked there every summer unless I was in school. Then I got out in 79 and started with the bank in December of 79 full-time. As far as I can remember, it was all I ever wanted to do. I don't recall ever having an interest in doing anything else.
When you became CEO, I feel like, what was the size of the bank then in 93? Do you recall, like, asset size?
It probably was $35-40 million.
So in the last 30 years, from 30 million to 1.7 billion, that's a pretty big jump.
Well, yeah. To do that organically, yeah.
That's right.
So especially started from Mullins, and Mullins, as I was telling you earlier, has been economically challenged for the last 50 years. Yeah.
So that was one of the biggest things, and one of the things I was most interested about talking to you. The banking kind of sphere right now, especially locally, and we have a lot of big banks that have compression on all small banks. The small banks sell to the big banks just across the country. You guys, what you're saying, gone from 30-40 million in 93 to current day 30 years later, 1.7 billion in our town or in our county, and you just opened something in Somerville 5 years ago. All you're doing is continuing to grow. So like what is separating what you guys do from other banks? Like how are you able to compete with others? Because this year, your shareholder letter said you're ranked first in the state for return on equity at 22.5% compared to the other banks' state average of 8.3. So like, what is it exactly that's in the water over here that you guys are doing so good?
Thank you for teeing that up so nicely.
You're welcome.
We have every time we have a new group of employees come in, and every month we have a orientation, and there's 5 to 6 new employees every month. And I go over there, introduce myself, and I tell them, I answer that question.
Sure.
And I tell them that we are, as unlikely as it seems, you're in downtown Mullins, South Carolina. We are the highest performing bank in the state, and have been for a few years.
It's crazy.
And the reason that is because we have the best bankers, and I don't say that just because rooting for the home team, so to speak. I mean, we got the best bankers, and how do I know that?
Yeah.
A, I work with them. I know they are. B, the people we're able to attract, other people are trying to attract as well. And we've been successful in getting those people that other banks are after. And that's true just on the commercial side. It's true in our indirect business. It's true in our mortgage business.
Sure.
So we're able to get those people that other people are after as well. And I'll credit Brian for a lot of that. Him and Mickey Watts, they're like talent magnets. Anyway, so we got the best bankers voluntarily giving their best effort. They're going the extra mile for us.
Right.
And when people voluntarily give you their best efforts, that's like lightning in a bottle, right?
Yeah.
You don't have to prod them; they'll do it on their own. So we've got the best bankers giving their best effort in a very proprietary business model. Our business model is unique, as I mentioned a few minutes ago. We're deep into consumer business, but we do 5 things that drives our top line and our bottom line. First thing we do is typical commercial banking, which every bank does. That's the price of admission. We do mortgages. Right now, our mortgage department is not adding a lot to our bottom line, but they're using that time very wisely.
Yep.
Putting in new software, new people, etc. So we'll be ready for the next turn there.
Yep.
So those 2 things most banks our size would do.
Of course.
The next thing we do, that we're very intentional and spend a lot of money marketing for small business and consumer checking accounts. Every 7 weeks, we're on a new campaign, direct mail campaign, and we're trying to attract those small business and individual checking accounts. The reason that's important is nobody buys checks anymore. They get the card and they swipe, and every time they swipe that card, we get a few pennies. So over a period of a year, it turns into a disproportionate amount of revenue.
Right. So to stop you there, who is that target customer for that small business consumer line? Is that companies under 10 people? Is that 100 people? Local businesses? Like, what is that target customer that you guys are trying to market towards there?
It's your local mom and pop type business.
Okay.
Yeah. And so on the credit side, the other two things we do that really distinguish us from the rest of the pack is our consumer lending business. And we focus, our target market is people with credit scores of 550 to 660. And that's unusual. That's kind of low for a bank to be in.
Yeah, absolutely.
But that's our folks. Now, we do that on the indirect side. Indirect meaning we have car dealers, probably 200 car dealers from North Carolina, South Carolina, and Georgia that through a portal send us applications for people to get a loan to buy a car.
Wow.
And so, as I say, we're over North Carolina, South Carolina, and Georgia with that. I don't know of one other community bank that's in that space in the country, and that's Crescent Bank out of New Orleans. And that's all they do. They don't do anything else. So I don't know of no other banks in the non-prime space like we are. I got some big breaking news here.
Yeah.
As of yesterday, our founder and our senior vice president of our indirect department, Mickey Watts, was elected president of the National Automotive Finance Association.
Wow.
Now that's a big deal. I mean,
yeah.
We're just a little guy in that space, but his other board members and whatnot is Chase, Wells Fargo, Capital One, Ally, those kind of guys, and he was elected yesterday as president. So I'm very proud of that.
That's insane.
Yep. So NAF, that's the National Association for the non-prime automobile lenders.
Wow.
So we do that, and then the other thing we do is we do the direct consumer lending, same target market, people produce and consume all their paycheck in the ordinary course of living and have a credit score between 550 and 660. And now you would think, well, don't most banks make consumer loans? And this is my favorite statistic of all times. Mm-hmm. We have about 35 to 36% of our loans in non-real estate consumer loans, mainly car loans, but also elbow loans, signature loans, those kind of things. Mm-hmm. Mm-hmm. And our peer group has determined by our regulators have less than 3% of their loans in non-real estate consumer loans. So it's an accommodation for, I think, that most banks offer to their deposit customers and their business customers. For us, it's a line of business.
How did you guys get started in that? Because I assume why most banks look at not doing that, lower credit score, theoretically a higher chance for those folks to default on a loan, which means you're charging a higher premium for interest and you're making more money on that. When did you guys get started? When did you see this as an opportunity to start doing this?
We stumbled into it.
Okay.
On the indirect side, in 1998, Mickey Watts, who had worked with TransSouth, which is kind of the one main of its day, he had come there and he couldn't work with us, and he came to me after being with the bank a few years and said, "Yeah, I'd like to make some of these indirect loans." I said, "What is an indirect loan?" He said, "Well, car dealers will send us applications and we'll decision it based on the application the car dealer sends us." I said, "That's the stupidest idea I've ever heard in my life." I said, "You're going to have these car dealers that want us to finance their profit, basically, in their inventory. They got every reason on earth to be fudged there." Of course, the car dealers at that time were not the Christian-hearted gentlemen they are today.
That's right.
The good God-fearing people now that we deal
Sure.
with.
Right.
But anyway, he wouldn't let it go. And every 30, 60 days, he'd come to me, "I got to make these indirect loans. Please let me do it." I said, "Finally, okay, go make three a month, but no more than that. Don't want any much of that." Now, I had no way of monitoring it, and he had no intention of doing just 3. And for years later, I said, "Well, why would he let that thing drop?" And I finally realized he was already doing it, and he knew I'd find out. And he wanted me to he wanted to be able to say, "Well, you told me I could do it."
That's right.
So,
wow.
So anyway, from there, we're now we just crossed over $250 million in indirect loans.
Holy cow!
And the thing I would say about that, it's a very steady performer. Yes, is a indirect car loan more risky than a construction loan or a house loan? It is, but the portfolio is very stable producer,
Interesting.
performer, and you do have a high level of losses relative to what bankers expect, but those are expected losses, and expected losses are not a sign of risk.
Yeah.
Unexpected losses are risky, but our losses, they're going to range between 2 and 5% over a 12, 15-year cycle.
Wow.
And they say, they're always very steady. It's a good steady performer. Even if the losses in dollar amounts add up, you're pricing for it. And
exactly
so
right.
So you get a premium for managing that risk.
Wow.
So it's a very profitable business. As far as the direct consumer side,
Yeah.
we were just, I grew up just taking in all comers. Whoever came in the bank and get a loan,
Yeah.
I did it. And I don't think I ever did it, but I could have made a $500 loan to someone to buy a set of tires and a $500,000 loan to a warehouse group to finance their tobacco sales.
Yeah.
I don't know that I ever did that one day, but I could have and wouldn't have thought anything of it. So we just took all comers. And finally we realized that this is kind of unique. And not only is it unique, we're not charging near what the finance companies are charging. So we got a huge competitive advantage here. So we got very intentional about it. And recently we asked one of our employees to go to a national finance company and borrow $7,500, then bring it back to us and let us see the paperwork. Let's compare how much competitive advantage we have. And even though I knew it, I didn't know it, but he brought back the paper and we ran what we would do the loan to him for. And it was a little less than half the interest rate, but on a $7,500 loan, he would save about $6,000 on a 5-year, $7,500 loan. That's like $100 a month.
Yeah, that's insanity. How does that even work? What was their rate? Your rate was half of what theirs was?
Yeah, they're charged 36%, which is kind of low in the finance company world. Okay, but that's at the lower end of what a finance company does. And this is a nationally known, very highly respected finance company.
Yeah.
And we were charging 12, 14, whatever it was, according to our underwriting. And so I was amazed to think that could save somebody $100 a month, which is big money. So why on earth would anybody that could borrow from us go to a finance company? And so that's been a struggle and a challenge to get that word out. Hey, we're a bank, but we make loans to individuals with credit scores that banks don't normally make.
Yeah.
And so that's been a challenge to get that word out, but we've had some success in it.
How do you bridge that gap to get that word out, right? Because I think maybe your standard business line of banking, or you guys do, I had a different question, we'll save it for later, but you promote the bank very, very well. You guys are very active in every community, but how do you bridge the gap of making sure people that fall into this bucket would have access to borrowing money from you guys at half the rate?
Tons of advertising.
Okay.
I think we first kind of realized this when we went to Dillon. Dillon has 2 banks there. Neither one will make any finance companies. Neither one will make personal loans. You wouldn't go there to make a personal loan.
Right.
So those people never thought to go to a bank. They go to a finance company or a credit card.
That's right.
So we realized that this is going to be a challenge. And the challenge is we got to make sure these people know they can come here and get a personal loan, whereas they can't go to any other bank.
Yeah.
So we did tons of advertising, and we hired a finance company person, and we advertised her. She was known in the community as a finance company person.
Yeah.
And so that's the challenge, is getting the word out that you can come here and save you hundreds of thousands of dollars on your personal loans.
Yeah, absolutely. How do you guys buy these loans, or how does the loan come to you? A couple minutes ago, I guess I don't understand the indirect process. So are you buying a bundle of these, so to speak, higher interest rate car loans that are coming to you as a portfolio of loans that you're buying or bidding on, or are you financing each individual?
No, we're the
car
on a car dealer.
Yeah.
Like I said, we got about 200 over 3 states, and we got loan officers, but in that industry, we call them underwriters.
Yep.
And they're in the field, calling on dealers, and those dealers there's a portal. That they put the applications in, sends it out to multiple lenders all at once, simultaneously.
Got it.
And then it speeds the game here.
Yeah.
You got to jump on them right away, and we got a scorecard that either automatically declines them, automatically approves them, or most of them go into a bucket where they got to be looked at by an underwriter. So the underwriter will look at them if they're not approved or declined,
right,
and then get right back with the dealer on the deal that we can do.
Wow.
And so they make the deal, and then they close the loan and ship the paperwork to us for funding.
No way. There's no way other banks. That seems so. It almost seems crazy that like a bank of your size is doing that. I mean, not that it's a bad thing to do. It's super profitable, but there's no way other people are doing that.
It's
very unique
unto itself. And I tell you, one of the things we were doing all this stuff manually years ago, and we didn't really understand there was a whole subprime industry out there.
Yeah.
And when we found that out, and Mickey started going to the NAF conferences and the other conferences, we found out there was also not only a whole industry out there, there was a whole software industry out there that catered to the non-prime industry.
Right.
It doesn't take a lot to decision and service collect somebody that's got a 750 credit score, but when they got a 580 credit score, it's a whole different ballgame. And you have very robust softwares and solutions for all that. It's very high tech. We got custom scorecards that rely on predictive analytics. We got collection scorecards. We got custom pricing engines. It's a if you're going to be in that industry, you got to be in that industry. Yeah.
Yeah. So covering that and growing that certain segment, you guys opened the Somerville branch in 2017, which to me on paper, and I think I heard it maybe in one interview you did, people in Somerville don't know you're there or didn't know you were there. So like, what is the plan for growth? And that's a new market for you guys, that Tri-County kind of Charleston market there. What made you want to move into that market? And do you have other plans to continue to do other new markets like that?
Well, that was by design. And what we wanted to do was go into a market where nobody knew us and go into a low-cost facility, i.e. a unit in a strip mall, just lease it.
Right.
And focus just primarily on one product, non-real estate consumer loans.
Got it.
Basically a finance company with checking accounts. And we wanted to see if that model would be successful. The reason we went to Somerville was Paul Lee, one of our underwriters, been with us a long time. He knew people down there. He was eager to do something, and so he kind of led our efforts there.
Right.
And so we went to Somerville, and what we determined is, yes, we can go into a market where nobody knows us, and we can make just consumer loans, and yes, it can be profitable. So that proved the concept. So the next question is, do we want to scale this? And the answer is, yeah, I would. I just hadn't done it yet.
Right, okay.
But I can imagine a cluster of those in the Low Country at Moncks Corner, North Charleston, that kind of thing. You know, that's I hopefully in my career I'll get to have a chance to do that.
Yeah, I mean that's an exceptional area. That's one place that I look for deals in, that greater Charleston market, so to speak, or Somerville. Right. Exceptional area, and I think tons of growth will be had there, just like we'll have here too overall. About branding of the bank, I think compared to other banks locally, and this is not a shot at any other bank locally, but you guys do an immaculate job presenting yourself and branding yourself. And I'm curious, is this just a marketing tactic of growing the bank to get small businesses? Because we play in a lot of golf outings, or Bill and I play in stuff, and you guys sponsor everything. You sponsor a hole, you sponsor the tournament, you sponsor this charity, that charity. Why is that so important to you? And then do you think that helps convert a lot of new business? Like what makes you guys want to do that most?
Well, it's just, we're a community bank.
Yeah.
And our mission is to create value for our employees, customers, communities, and shareholders. And the way we create value for our communities by our leadership and our participation and our contributions. Yeah. So that's just integral to who we are and what we do.
Yeah, it's fascinating to see. I think it's just light years ahead of other competitors, and I think it makes a difference too overall. Transitioning a little bit into real estate, with the current market right now, commercial lending is obviously tricky for anyone to put a deal together. How do you, as the CEO of the bank, navigate these markets? Deals, one, are probably not coming every day to buy an apartment building or a warehouse or this or that, but how is the loan structure going to be changing in this environment for you? Is it, or even the relationship with people that want to borrow money from the bank? Is it, hey, we only want to lend to people that are going to bring deposits over, maybe we'll shorten the AM, or what is important to you running the bank in this market?
Let me say, we're more selective now than we were.
Right.
We're not doing every deal that comes down the pike anymore, and I don't think anyone is. So we've become more selective to those folks so we can have a relationship rather than just looking at a transaction.
Yeah.
And that's largely been true all along, but it's more so now than it has been. As far as how we manage that in this environment, as I said a minute ago, we got leaders that are in and of this market that are plugged into it. And we stay in close communication with them and let them lead us in that path. And Brian at Myrtle Beach and Richard in Western Horry County, that's their job to do that. And they're doing a great job at it.
Yeah, I love that. Transitioning, we can make this kind of the last segment, but was there a deal or a point in time or any acquisition that would be a good deal story to tell, or a new line of business that you added? Anything kind of in particular, story-wise? Maybe we can get into the numbers or adding in. Maybe
I will tell this. This is an interesting story,
Yeah.
I think. As I said, we were ill prepared for what happened in 2008.
Mm-hmm.
And frankly, I put the bank in the ditch.
Oh,
And luckily, I had a lot of help getting it out. But one of the interesting things that happened during that period of time is that at that time, we were still fairly new in the indirect business. We had a portfolio of about $24 million. And when all of this real estate losses started coming, and from 2008 to 2012, I calculated one time we had about $75 million in total credit costs. That was legal fees, losses, write-downs, expense, everything.
how much?
$75 million. And I mean, we went for years paying enormous legal fees, but anyway, that's another story. So you would think, well, that must have dug deep into your capital, and it didn't, and here's why. In 2008, when things went bad, what happens in the indirect subprime business, the lenders go away.
Right.
So it left it all for us, more or less. So we were able to raise our prices up, our pricing up, and expand. So we were able to grow that portfolio from 24 million to 65 million, and we were yielding after losses at that time like 14%. So that happened a lot faster than we ever imagined we could grow that portfolio. I mean, we thought we might get to 30 million and help out. We went to 65 in,
Wow.
like I said, 18 to 24 months. And when you got that type size portfolio yield, that kind of yield after losses, we were able to churn through those real estate losses, not easily, but it hardly nicked our capital because we had that diversity in our income. So that was a big deal for us. It really helped us, and it got us out of the ditch a lot faster than a lot of banks. A lot of banks didn't make it. I think it was 4 or 5.
That's right.
Didn't make it here. And if you go back and study their call reports, which is the reports all banks have to file every 90 days.
Yeah.
You said they had the diversity in their earnings. They were top heavy. They had all their loans in
CRE,
construction.
yeah.
Yeah. And we had that too, but we had the consumer loans to help us dig out of that hole.
Wow. How long do you think it took you guys to dig out of that hole? Over that, past the 2012, past the 4-year mark, or?
We returned to profitability barely in 2012.
Okay.
Yeah, it took us 4 years.
This is a little bit more personal of a question for this time period. So 2008 happens, you see all these legal fees and loans defaulting. How is that for you every day as the CEO? Like, what does that feel like running a bank? I mean, you're in some way, shape, or form, or more directly, responsible for a lot of people's well-being, a lot of people's jobs, a lot of people's income, running the bank. How was that for you every day? Like, did you see a way out? Did you see like this opportunity to claw back, or were there darker times during that cycle? What was it for you day to day?
I look back and I never was really concerned about it. And I don't know why. I think I just like that environment where a lot's required of you. I felt like we were de-risking the bank, the balance sheet, and we were. Mm-hmm. Had a lot of stuff in there that didn't really belong in there. Other people were rising to the occasion, and I like that aspect of it. That we were, I put us in the ditch, but a lot of us, the team pulled us out.
Right.
And right. I enjoyed that process of building that team and working with the team. Wow. So it wasn't an awful experience. I was looking forward to getting through it. Mm-hmm. I always thought one more quarter we'll be out of this thing, and it went on for years.
Sure.
But other than that, it wasn't that bothersome. And I made a personal effort to make sure that I was smiling and lighthearted about it when I could be, because I didn't want anybody to get too concerned about it.
Wow.
But we would have meetings, and we'd go through our problem loans and charge off $400,000 or $500,000 and have it every few weeks. And so, but it never really got me down. So looking back on it, I'm not sure why that was. I guess because everybody else was in the same mess we were in.
That's right.
I guess that probably helped a lot.
Yeah. Was there anything else that you or the bank learned from that cycle besides, I think, what many other banks learned, and that could have been more on the underwriting side, how you manage risk. But was there anything else that you guys learned through that recession or just that cycle, or even leading up? Because we kind of have the same thing happening now, much different, but the same thing as far as real estate prices were going through the roof leading up to that in this market, Horry County. Similar to now, was there anything else that you learned from that cycle besides obviously how you guys diversified the bank's income? I think is a big thing too. But anything else that was a big takeaway from that economic cycle?
How to run a bank, I guess, would be the best answer. Back then, we made credit decisions like I make most decisions. I kind of look at it and kick the tires and say, okay, that looks good. Of course, that worked until it didn't.
Sure.
So now we got a whole process and all the stuff we go through in our underwriting, our credit department. And also, we've got my nephew is our senior loan officer. Him working with Richard and Brian, they got good credit skills, and they know how to say no, and it doesn't bother them. Where I came up with a scarcity mentality on loans. I want to say yes to everything.
Right.
But I'm out of that now, and they don't have that scarcity mentality, and they're doing very well. They're very disciplined lenders. I like that.
Awesome. Last couple questions. Is there any other piece of, I think, history of Anderson Brothers Bank that we missed that would be cool to share? Because I think you guys are so rich in nature here that I don't want to miss anything from there.
Let's see.
And then otherwise than that, to wrap, I would love to know what's next for you guys as a bank. There's certainly, we've got some weird economic headwinds to say the least right now, but is there any other service or market that you guys haven't? So is there any other service that the bank doesn't have today that you would like to do or add that line of service? And two, is there any market that you haven't been in? And I think you touched on this a little in South Carolina that you would love to expand to.
Well, our next expansion will be Carolina Forest. We'll be building a branch there.
Very cool.
We've got a loan production office in Sumter. We'll at some point we'll be building a branch. And then we've got a couple others kind of fill-ins that we'll be building branches in the next few years, I think. As far as services, we're pretty much got everything we need right now. What we don't have, it'll be more like bolt-on for the new services.
Yeah.
In fact, we got a crew today looking at, I don't even know where they are, I think they're in Indiana, looking at a lockbox service. So, and we got a lockbox service, but we're going to expand it, I hope.
Oh, wow.
So I think we pretty much got all the services we need, and we're getting ready to do a major conversion of our software, our core processing software, and that might enable us to provide some additional services.
What do you think that will help the most with the turnaround on transaction?
In the cash management area, it'll be an upgrade there for us, which has become a very big business for us. And then it'll have some credit aspects to it that we don't have now. It'll add a credit platform that we don't have now. We're pretty much doing everything with spreadsheets and email, and that'll change that.
Yeah,
so,
a little bit.
And that's a needed change.
Yeah, absolutely. I think this was fantastic. Anything else to add or any other bits?
I can tell you about PPP story.
Yeah, please do. Yeah, that'd be great. I was going to ask about that earlier.
All right, PPP, we all, of course, know what that is now, but when they opened up the PPP portal, or said that we're going to do these PPP loans, and in 1 week we got, I think it's $16 million in loan applications in 1 week for PPP loans. Ooh. And we were just overwhelmed. And the thing about it, it was being offered through the SBA, and we didn't know anybody at the SBA. Nobody at the SBA knew us, and it was a new program for them, so it was just chaos. Nobody knew how to do it. Mm-hmm. So Friday afternoon, our chief operating officer, Rusty Richardson, was in my office, and he was really distraught. He said he's got all these loan applications and no way to get in the portal, no way to make these loans, get them approved.
Sure.
And so I left him thinking we'll get back on it Monday. Anyway, Saturday morning, about 7 o'clock, I got an email from him that he's in the portal and he's entering these loans in. And so he assembled a team on Saturday, and they worked until into the night, getting all those $16 million in loans into the SBA portal.
Wow.
And then Monday morning, we're closing PPP loans. And at the time, it's just a matter of days or weeks, but most banks at that time, they didn't know if they were going to participate in it or not.
Yeah.
So word got out that we were participating in it, and we're closing loans. And so we did just under $150 million in PPP loans. About 40% of them were to non-customers. Now, guess what? They're our customers. Yeah. So, we had people from Greenville who are now our customers.
No way.
Applying they couldn't get their bank to do the loan for whatever reason.
Yeah.
And so they came to us, and we had some. Rusty did us a great job there. We had 3 branches that really worked hard: Conway, Church Street, Merle's Inlet, and Grissom. Well, they really led the charge there in getting those loans done.
That's fascinating. It seems like the theme, at least one of your leadership qualities, is you guys are able to move fast on a lot of opportunities, even though you are pretty, I would say a big bank. Like whether it's PPP or taking on the car loans, it's like you can see the opportunity and move on it. And I don't think not many companies that are decent size are that nimble to do.
Well,
right?
that's a good point.
Yeah.
Some years ago, maybe 10 years ago, the FDIC did a study. And the question they wanted to answer was, does the nature of ownership of a community bank impact the performance? And what they came back was, yes, closely held, closely managed banks outperform broadly held, professionally managed banks.
Right.
And as I said, I've been the chief executive officer for 30 years, and I represent the ownership of the bank.
That's right.
And I'm here in the bank. So rather than have stockholders, board, senior management, it's all compressed into one. So that does give us, we're able to move quickly and be very nimble. And the interesting thing about it, what it does, it allows for us to empower these people. You would think I'm making all the decisions. I hardly make any decisions because I'm working closely with the Bryans, the Richards, and the Riverses of our bank. Yeah. So I'm comfortable with empowering them to make decisions, so they can make decisions for their area. And one of our values is ownership. Run it like you own it.
Right.
And I found that to be an excellent way to manage an organization, is to run it like you own it. And we were able, because we're so close,
right,
we're able to empower those people very comfortably, and they do it. It's the best way to manage, I think.
I think it's amazing. I think that's a good place to stop. That's the best little bit. I think we could finish with. Thank you so much, David, for coming on. This was awesome.
I enjoyed it.
Appreciate it. Awesome.